If you've been watching the news this week, you've probably felt that knot in your stomach. The numbers are out and they aren't what anyone wanted to see. Inflation has reaccelerated. The CPI index just hit 3.8% over the year to December, up significantly from 3.4% in November. For months, we were told the beast was tamed. We were told to expect cuts. Instead, we got a nasty surprise. And when you dig into what is driving this, it gets even stickier. It's not just one thing, it's everything. It's the essentials: house construction, electricity, food, childcare, and non-alcoholic beverages. Now, naturally, the media is screaming market crash. They're telling you that because inflation is up, the property game is over. But in this video, I'm going to show you why that is fundamentally wrong. I'm going to explain why this specific type of inflation, driven by construction costs, is actually the jet fuel that is going to drive Brisbane property prices up by 10 to 11% this year. This is the PropSpotter Deep Dive. Let's get into it. Firstly, let's address the elephant in the room. Next week, the Reserve Bank of Australia meets. With inflation jumping to 3.8% and the labour market data coming in incredibly strong, unemployment is still historically low, the RBA is backed into a corner. The market is now pricing in the very, very likely chance of a cash rate increase. The pivot to rate cuts, that's gone. We're likely looking at another hike to cool this new flare-up. Usually, Economics 101 tells us that interest rates up equals house prices down. Why? Because your borrowing capacity shrinks. If the bank lends you less, you can pay less. Simple, right? That was true in 2022, but in 2026, the rules have changed. We're entering a phase I call the inflation paradox. The very thing that is forcing the RBA to hike rates, spiraling construction costs, is the same thing that is putting a floor under Brisbane property prices. Let's look at that CPI data again. Rising cost of house construction. If you own a block of land in Brisbane right now and you want to build a standard family home, you are paying significantly more than you were 2 years ago. That actually applies all across the country. Materials are up, trades are scarce, and electricity to run the site is up. This has created a supply cliff. Developers can't make the numbers stack up, so they are cancelling projects. Builders are going bust. New approvals are dropping off a cliff. But here's the kicker. The population isn't stopping. People still need a roof over their heads. So if you're a buyer and you realize it costs $1.2 million to build a new house, but you can buy that same house already built in an established Brisbane suburb for $950,000, what do? You buy the established house. This arbitrage is driving massive demand into the existing housing market. The replacement cost of property has skyrocketed all across the country. And until existing house prices rise to meet the cost of building new ones, that growth is mathematically done. This brings us to Brisbane. While Sydney and Melbourne struggle with sheer affordability limits, Brisbane is the sweet spot of this storm. We are forecasting Brisbane to continue growing at 10 to 11% this year. Why? 1. Relative affordability. Even with recent growth, Brisbane is still cheaper than Sydney. Number 2, the migration factor. The strong labour market means people are moving here for jobs, not just lifestyle. And number 3, the supply crunch. Brisbane's topography and council restrictions mean we simply aren't building enough homes to house these people. When you have a rate hike, it knocks out the marginal buyer, the person who's stretched to their limit. But currently the demand for Brisbane is coming from cash-heavy upgraders, interstate investors, and people downsizing who aren't sensitive to a 25 basis points rate hike. They are looking at the lack of supply and saying, if I don't buy now, I won't get in. That, ladies and gentlemen, is fear of missing out, driven by scarcity, not cheap money. That is the fundamental difference. However, we need to be realistic. This gravy train can't keep growing forever. Trees don't grow to the sky. If rates go up and prices go up 11%, we will start to hit an affordability ceiling. So where do you look? The growth in 2026 is going to ripple outwards. The inner city blue chips are great, but the borrowing capacity hit from the RBA will push buyers into the next tier of suburbs outside the current tier they're looking at. Some value corridors to consider, the ones in the Moreton Bay region, like Petrie, Strathpine, and on the other side, the Logan region, Springwood, Daisy Hill, Slacks Creek. These areas offer land content which is expensive to replace at a price point that average families can still borrow for even on higher rates. Gentrification zones. Look for suburbs that are older post-war homes that are too expensive to knock down and rebuild. Renovated delights in places like Stafford or Maruka will trade at a premium because the bones are already there. But here is my warning and the watching brief. While 2026 looks set for double-digit growth due to the supply shock, we need to watch 2027 and 2028. Eventually, if wages don't keep up with this 3.8% inflation, the consumer begins to break. If the RBA keeps hiking into a slowing economy, we could see a stagnation period after the boom. The strategy right now: you are buying for the scarcity of the structure. You are buying the house because the cost to build is rising faster than the interest rate is hurting you. So there we have it, ladies and gentlemen. To wrap it up, the CPI is 3.8%. The RBA is likely hiking next week. The media will tell you to panic, but the smart money sees the truth. Construction costs have put a protective moat around established property prices in Brisbane and the rest of the country. We are looking at a 10 to 11% rise because people need homes and we can't build them fast enough or cheap enough. The question is, do you know which suburbs have the tightest supply and the highest demand? Don't guess it. The market is moving too fast. You can book a free strategy call with PropSpotter on our website, propspotter.com.au, and we'll find you an asset that inflation helps rather than hurts. I'm Sean. Happy hunting, and I'll see you next week after the RBA meeting.